was a good result for me. I mean, given the fact that a week ago our forecast for the first half was an underlying NPAT of 1.4 billion, and it came in at 1.56 billion, so that's only a touch or 90 million below where we updated our number 2 on Monday. And that's probably indicative of what's happened with consensus, where there's been pretty rapid consensus upgrades through the year leading into the result, and something I don't expect will abate now, given the fact that spot commodity prices are still much higher than what the majority of the market, including us, have in our model for calendar year 2016. So looking at the result, it's still obviously carried by the iron ore division. The iron ore spot price being above $60 per tonne is way stronger than what we or again, the market expected. Rio point to the fact that there was an undeniable improvement in demand fundamentals for the iron ore market during the half. And what really drove that was easing of credit and increase of credit availability in the Chinese market. So that drove sharp rises in things like construction activity, also helped to clear some of the inventory in Tier 1 and Tier 2 cities of housing that have obviously been well covered in the market. So floor space sold increased in the half, on average each month, but 25 to 30% growth, so it's exceptionally strong. And housing starts were up in the same period, 15 to 20% each month, so year on year annualised. So incredibly strong periods of growth that really did help to aid in or put at least some pressure on that surplus in the seaborne market. With that said, that Rio were exceptionally conservative in their commentary, saying that they can't rely on that recent strength, and did mention the word volatility 11 times when talking about the outlook. So they're really trying to get manage expectations, but also probably unsurprising given the fact that they are, as they admitted, in acquisition mode. And historically, the big miners have always talked down the market when they're out there buying, if you're a cynic. So I'd have to say, looking at the result by division, iron ore, as I said, dominated. EBITDA margin of 58%, which is exceptional. The next strongest division is diamonds, which is much smaller, but that had 35% EBITDA margin. So it's really iron ore that's carrying the overall profitability of the business at this point, while things like the Alcan assets in alumina and aluminium, as well as coal, even though we've had a good increase in prices in thermal, are still lagging in profitability. So it really is a disconnect between the company's long-stated target of having only Tier 1 assets in the portfolio, and although they didn't go as far as saying they've got a mandate to sell assets, Rio's new MD did say that they're not wedded to any asset they've got, and if they did receive a fair price, they would consider it. So maybe there is potential for further sales, like the Bengala asset, which they sold to New Hope recently at a good price, and that could create more upside potential for things like capital management. So they paid a dividend of US 45 cents for the half. We in consensus were at 40 cents. For the full year, they've said that they won't pay any less than US $1.10 per share. But it's really hard to get confidence around what exactly the dividend will be, given the fact that they've purposely been vague in their guidance, just to give, and reasonably so, just to give themselves optionality and flexibility in setting that dividend based on what the second half cash flow performance will be for the business as it starts to manage some of these growth projects it's going to bring on in its existing portfolio, especially the Oyu Tolgoi underground development, which is a multi-billion-dollar copper project in Mongolia, which is stage 2 of the open pit, which is already in operation, that's going to get under development this half. So just to wrap up, Rio's had a great run in share price. I'd have to say that close to $50. We do have our last price target is $51.90 prior to the result. Our view hasn't changed. We've still got a hold, which we're maintaining. And just the view that if some of that volatility does come through the market, you might get a better chance to add to portfolios. But it's been a great ride otherwise in what is a quality operator, but still maintain our preference for BHP, just on a view that on a comparative basis is cheaper.